If you look at the trillion-dollar cryptocurrency industry today, you'll find a massive, towering ecosystem of projects and tokens, and right at the base of that structure, supporting the entire weight of the market, is a single asset, Bitcoin. To understand what this bottom block is supposed to do, we have to look at Satoshi Nakamoto's original 2008 white paper. Nakamoto described Bitcoin as a peer-to-peer electronic cash system. The explicit goal was to create a decentralized alternative to banks, where people could send digital money directly to each other. But if we want to know whether Bitcoin actually achieved that goal, we can't just listen to the internet marketing. We have to measure it against the three universally accepted criteria economists use to define money. When you put the crypto narratives on pause and run Bitcoin through those strict economic tests, the hard data reveals a reality completely detached from what the industry claims. The first requirement of money is that it has to work as a medium of exchange. This means people can easily and efficiently use it to buy things every day. This chart compares daily transaction volume. The Bitcoin network processes roughly 500,000 transactions per day. Visa handles about 65,000 transactions every single second. Bitcoin's entire daily volume could be cleared by the Visa network in under 8 seconds. To make matters worse, processing a single Bitcoin transaction consumes roughly the same amount of electricity as the average American household uses over 43 days. That single Bitcoin transaction carries a carbon footprint equal to roughly 1.5 million individual Visa swipes. An asset that is this slow, expensive, and resource-heavy fails the basic utility test of a functional, widely adopted medium of exchange. The second requirement is that a currency must act as a reliable store of value. It must hold purchasing power steady so you can spend later without taking a loss. The cryptocurrency industry often refers to Bitcoin as digital gold to imply stability, but historically, Bitcoin can swing 20% in a single month. People and businesses treat extreme volatility like that as a speculative gamble, not a safe place to store their net worth. Looking at Bitcoin ownership, while the network is supposedly decentralized, roughly 2% of addresses control 95% of the total supply. Because ownership is incredibly top-heavy, a small group of large holders can easily manipulate the global market price. We saw this vulnerability when trading firm Jane Street was sued for allegedly helping trigger the 2022 market crash, wiping out $40 billion in value. You cannot have a reliable, safe store of value when the asset is defined by extreme price swings and highly concentrated, manipulatable ownership. The final requirement is that a currency serves as a unit of account. Even businesses that enthusiastically accept Bitcoin don't actually price their items in it. They price everything in dollars and use Bitcoin as a temporary pass-through at checkout. We actually have a real-world experiment. In 2021, El Salvador adopted Bitcoin as legal tender, attempting to make it an everyday national currency. The government pushed hard. They mandated that businesses accept it. They launched a national digital wallet called Chivo and gave every citizen $30 worth of free Bitcoin just for signing up. The system was supposed to fix international money transfers, but according to IMF data, Bitcoin accounted for less than 2% of El Salvador's remittances. Citizens overwhelmingly stuck to traditional banks. The national wallet didn't fare any better. Data shows that 60% of the people who downloaded the Chivo app just cashed out the $30 bribe and completely abandoned the platform. Here, you have a scenario where a country legally mandated the use of Bitcoin and financially bribed its population to participate, and the people still rejected it. The theoretical arguments fall apart in the real economy. So if Bitcoin fails all three economic tests of money, doesn't generate corporate cash flow like a stock, and doesn't produce physical goods, what exactly is holding up a trillion-dollar market cap? The answer lies in an economic concept known as the greater fool theory. This chart illustrates a system where the price of an asset is justified entirely by the belief that someone else, a greater fool, will buy it from you later on for a higher price. When you apply this model to the crypto ecosystem, the mechanics become obvious. Bitcoin's rising price depends entirely on continuous new demand, completely divorced from any real underlying utility. To keep that demand flowing, the industry needs a constant stream of new buyers. Stories about digital gold and the future of money are carefully crafted marketing tools designed to recruit the next wave of capital, and the math behind this is merciless. The exact moment new money stops entering the market, the sequence breaks, and the entire machine comes to a halt. If you look past the complex technology and the online hype, Bitcoin is simply the largest real-time experiment in the greater fool theory in human history. It runs on pure hope, waiting for the day it inevitably runs out of greater fools.